Hi everyone. I wanted to talk today about like portfolio allocation, which means that basically how to balance your portfolio with a number of shares to be able to prevent yourself from taking too much risk or prevent yourself from having too much dilution. So let's go to the introduction. So, as an introduction, today we're going to talk about how to manage a portfolio, then like what sizing you give for each company, so how many percentage you would put per company. Then we will look at the risk reward, so when like how much to put, what's the reward you're expecting, how much it contribute to your gains, and what if it doesn't, like, so yeah, that out. Then we will go with the performance, so basically give you like what happens after 2-3 years, for example, in a portfolio, and what you should expect from it. And then after basically return, profit, and scale, be able to know what to do from there to expand and protect what you gained so far. So in this chart, you can see two kind of portfolio. So I give like mainly like the major one. So there will be some people saying like, oh, 3 to 5 stocks are all you need, which is like someone like Charlie Munger was saying that. Or there is like people like Peter Lynch that had like thousands of stocks. So they still did well, both of them. So there's no real rules in there, but I would say that personally it's at least like 10, so but lower risk, like 10%, especially when you start. 5 to 10% in each stock is probably a good start, to get to know what's working and what doesn't work. If you lose the whole stock, you will lose only 5-10%, not 20 or more percent, which I think it's much safer and makes you feel less worry at night, especially. So yeah, after the, like, each stock has more or less risk, so depending on what they are. For example, if they have a lot of debt, you can still take a position, but you know that the risk will be high, so it might be sometimes better to just take a smaller position, maybe even 2% or less, depending obviously of the size of portfolio, but still a lower position than if you would in a bigger, like more comfortable like company where you think there is like great return potential with a limited risk. So in this case, I would actually have more like 5 or 10% in the portfolio, because they are less risky. They may get a bit less return sometimes, but that is the balance you have to get right. So yeah, no one knows which stock will do very well or which one will not do very well. So that's why, in my opinion, as not knowing for sure or not knowing every part of the stock market, which I think everyone else doesn't either, it's safer to just go with like several bets, see whether it works or not, reconsider, and then try again, and then help you go over, So now we're going to talk about the risk size, so what I was talking earlier with the percentage. So I remember Monish Pabrai in one of his videos mentioning that he would pick like a 2%, 5%, and 10% size bet. I thought that was actually a very interesting, so I started from there pretty much, and I try to adapt to myself. I'm a little bit of a risk averse, so I try to pick 2, 3, and 5%. So here's the chart where you see like what Monish Pabrai would do, and then in blue and then in orange is what I decided to take. So obviously it's just an idea, right? It's not like always like exactly 5, could be 6, 7, or 8, but it's just depend like I would say that on average it will never be 10 or over, but more less than 10. I prefer to take smaller companies as well and have bigger portfolio because there's more risk in the smaller ones. Well, but the return are outside, so usually I would say that because the return is good, I don't need to worry as much to have more stocks. So this is the risk reward. So it shows basically on like this is an example with bets. So I would say obviously it's when I put bet, I mean it in a way that you buy a company and you like would expect 1 out of 4 to do very well. So if that happens and 1 out of 4 does quite well and all the other 3 fail, you would pretty much break even. So I'm not saying this is what's supposed to happen, but I'm just saying that if one does well, all the others companies, even though they go bankrupt or go to zero, you still break even. I find that like pretty much what I'm looking for. So I would not want, obviously, 75% of my companies to go bankrupt. That's not the idea. It's just to make an understanding that a good win could actually beat all the others and beat the average, and this is what I'm looking for at the end of the day, to grow the portfolio a bit bigger. So yeah, usually smaller opportunity like small to medium companies offer this kind of return compared to much bigger companies that can't really triple or quadruple, and that's what I'm looking for, especially. Yeah. So one person I really like, which is Peter Lynch. I've read most of his books and listened to a lot of videos he had, which not that many, but quite a few. And he actually, if you were to look at it, chapter 3 in the book One Up on Wall Street, he's mentioning about like the idea that if 6 or 7 stock would do quite well, like then you will have a pretty good return by default. So the idea as well went a bit further in one of his video where he was saying like as long as you have 1 or 2 stock that do quite like extremely well, and then 3 or 4 to perform like average plus, and then the rest do nothing or go down or more, like 1 or 2 goes down quite a bit, you will still have a pretty good portfolio increase. And basically that's all you need. It's not just about making all the companies making money. If one does badly, you can't expect everything to go as expected. Sometimes things doesn't occur or something doesn't work out as expected. So this is in here I would give you an example of portfolio growth over 2-3 years, for example. So you start with a portfolio of $10,000 with $1,000 per stock, and what would happen after 1, 2, 3 years. So this is an example of something I would say that where your portfolio did quite well. I mean, in 1 year it's a lot, but let's say to be safe, let's say 2-3 years, there's a chance, so it's not a certainty, that one stock will do 5x, and one stock will do 3x, 2 would do 50% gain, 4 would do nothing, and 2 would go down 25% or more. But this is just an example. And so at the end, in this case, we increased by 65%. So I wouldn't say to expect that every year, but after 2-3 years, it's potentially possible. But it's just to show you that one big gain could actually replace all the loss of the other ones. So having just 1 or 2 doing quite well will actually make you like your portfolio grow very quickly, even though the others are not doing quite well, and that's the whole idea. So this is a nice way to grow your portfolio, and I would say once that happened 2-3 years down the path, it would be recommended to maybe sell some that did quite well, even though you know you could expect to grow more, it might be good to sell a little bit, part of it, and then like keep it or add more into basically add new stocks. Or if you believe that the stock that did nothing is much better, then you can add more. But otherwise, if you think it's just the same story or less good, it's better to not add, because usually adding to your losers is not recommended. But adding to a one that is actually really like much cheaper than it was, and like basically a book value very low, like 0.5, definitely I could potentially sometime add more, but that's to be very cautious. I would say the best is to get another stock and just expect that one to grow as well, and get it ideally cheap. So this is a little bit similar to what I was saying in the previous slide. So that means that if the like the portfolio doubles, like it's probably a time, because there will be usually one stock that do extremely well, would probably be smart to at least cut a little bit. Even though the company is doing amazing, we don't have to sell the whole thing, because like it's not the idea. But maybe saying 20 or 30% could be a good move, because at least you can actually get the gain from that company or whatever you put in it, if it does especially triple or more. So you will have your money back already, and then basically have the stock there still, and still quite a bit of a stock, because 70% left. Then you can place that money into another stock that you believe is going to do great, or just sit back and wait for the opportunity. And if stocks are going down, it's the opposite. So basically you have to watch them and basically figure out, do I keep it or not? If it does nothing for a long time and it's close to break even, maybe why not just take them out if you don't believe it anymore, and move to another one that is more potential. If they are down 90%, well, I guess that's probably not worth bothering too much. But like it could happen. It's rare, but it still happens from time to time. So I would say anything between 5 to 10% like down, if you don't like it anymore, it's probably better to sell it quick rather than just wait further downside. But sometimes you don't realize, and it just goes against you, and it's part of the game. I mean, stop loss could be useful, but I haven't used it as much long term, because I just think it's a little bit tricky, and I'm happy to lose the whole bet, but have many, rather than trying to place a stop loss where I'm not too sure what it's leading to. So to conclude, I would just love to say that, portfolio management is very complicated. I would say that it's not like there's no right and wrong, but there's just ways to mitigate the risk. And I'd say this is really good to think about it and improve along the way. I would say at the beginning it's really difficult, because you have no idea how things work, but after a while it starts to be a little bit easier, because you would take one idea, and then just when it goes well or not, you would decide whether to reduce or add, and then over time it would just become a little bit more automated. But at the beginning, I would say this is what I struggle the most, because it's super hard to have the risk reward in your head and get quick ideas on what works and what doesn't, and how to take out some and reduce some, add some. This is difficult, but yeah, at the end of the day, I would say that having between 10 to 20 stocks or more, 30, I would say up to 30, because after it's way too much work, then it's probably a good overall portfolio with less risk. You can have 5 or lower, but I would say you need to know what you're doing, maybe have some stop loss. You have to be way more, understand way more each company. Then I would say that like I would go with 2 to 8% allocation personally, but you can probably go to 10%. And then anything above, I would say, is more for people that really know their companies, know it inside out, and really have confidence. So I would say once you get more confident and you like having less companies, then do that, but maybe not at the beginning, because at the beginning you will make mistakes, and mistake could cost you a lot if you have only 3 or 4. So that's it for that video. So I'd love to know what you think and if it's good explanation. Yes, thank you.